Hi guys, welcome to my channel. Imagine you have $100,000 in cash. You want to earn interest, but you also want something safer and more predictable than a stock. There's a problem. If you put the money into an ordinary saving account, you can usually withdraw it whenever you want. But what if you're willing to lock the money away for a specific period in exchange for a more structural return? That's where a certificate of deposit or CD comes in. But here's the interesting part. Not all CDs work the same way. Some can be traded in a secondary market. Others are locked until maturity and impose a significant penalty if you withdraw early. So today, let's break down how CDs work, why banks issue them, and most importantly, the difference between negotiable and non-negotiable CDs. Let's start with the basic idea. A certificate of deposit or CD is essentially a debt instrument issued by the bank. The bank needs funding. You have money to invest, so you give the bank your money. In exchange, the bank promises two things. First, to pay you interest. Second, to return your original principal when the CD matures. Think about relationship this way. When you buy a CD, you effectively lending money to the bank for a specified period. The bank gets funding today. You receive interest over the life of the instrument, and at maturity, the bank returns your principal. So economically, a CD is a form of bank debt from the investor perspective. Okay, now let's switch perspective. Why would a bank issue a CD instead of simply relying on ordinary deposits? Because banks constantly need funding. A bank receives money from depositors and use that money to make loans and investment. But banks also need to manage the maturity and stability of their funding. Cities provide another stock of funds. The bank receives cash today and know how long that funding will remain available. That can be valuable for managing its balance sheet. For example, a bank might raise funds through CDs and then use the fund to support mortgage, business loan, or other investment. So from the bank's perspective, CDs are funding instrument. From the investor perspective, CD are investment that generate interest income. That's the two side nature of financial market. One person asset is another person liability. Now we get to the more interesting versions, the negotiable CD. Negotiable means the security can be transferred or resold. This is important. Suppose you buy a CD that matures in 1 year. 6 months later, you suddenly need cash. If the CD is negotiable, you may be able to sell it to another investor in the secondary market rather than waiting until maturity. That creates liquidity, and this is exactly why negotiable CDs are attractive to institutional investors. They provide two things simultaneously: yield and liquidity. You earn interest from holding the instrument while still having the possibility of selling it before maturity. The stock material highlights several characteristics of negotiable CDs. They are typically issued in large denomination, commonly multiple of $100,000. Their major range from approximately 30 to 365 days, and most importantly, they can be resold in secondary market. They can also be issued in period form. What does period form mean? It means the holder's name isn't recorded on the issuer's books or necessarily printed on the security itself. Ownership is essentially associated with possession of the instrument. For modern investors, the more important concept to remember is that negotiability creates transferability, and transferability creates liquidity. Now compare that with non-negotiable CDs. Here, the investor cannot simply sell the CD to another investor, and they generally cannot redeem it from the bank before maturity without paying a substantial penalty. So the trade-off changes. You must still receive interest, but you sacrifice liquidity. Think about it as locking your money inside a box. The bank knows it's had your money for a defined period. You receive compensations for providing that stable funding. But if you suddenly need the cash, getting out can be expensive. This is why maturity matters so much. An investment can look attractive because of its interest rate, but if your cash need change, a lack of liquidity can become major disadvantage. This is one of the most important comparisons to remember. A negotiable CD can be transferred and sold in the secondary market. A non-negotiable CD generally cannot. Negotiable CDs are typically issued in the large denominations, such as multiple of $100,000. Non-negotiable CDs can be issued in much smaller amounts, ranging from around $5,000 to $100,000. The maturity range can also be much broader, from as little as 1 day to several years. So there is a clear trade-off. Negotiability gives you liquidity. Non-negotiability gives the bank more stable funding but reduce the investor flexibility. One more point is important. CDs aren't exclusively a product of traditional chartered bank. Trust company and mortgage loan company can also issue similar instruments to raise funds. You may encounter different names depending on the institutions. For example, DRs, deposit receipt, GTCs, guarantee trust certified, GICs, guarantee investment certificates, GIR, guarantee investment receipt. The name may differ, but the underlying economic idea is similar. An institution receives funds from investors and promise a return and repayment according to the term of instrument. From an investor's perspective, the key question isn't simply how much interest does this city pay. You need to ask several questions. How long is my money locked up? Can I sell the security? What happens if I need the money early? Who issued the instrument? What is the credit risk? This is how professionals evaluate short-term instruments. A slightly higher yield may not be attractive if it comes with dramatically lower liquidity. Thanks for watching.